Yeah, so pretty much we are done with the introductions. This slide shows you how we've actually structured the presentation. Pretty much we'll just showcase how COVID-19 has impacted the various economies, both the global, the region, and in Kenya. Also, we'll talk about the credit industry and how that has been impacted, basically what has happened in the credit industry as a result of COVID-19. From there, we'll showcase some of our solutions that can enable financial institutions to cope with the ravages of COVID-19. So it's going to be pretty much in a nutshell, that's going to be what our presentation will be about. So for Creditinfo, as you might all of you know, we are one of the 3 licensed credit bureaus in the industry, and we came about as a result of the Credit Reporting Act of 2010, and CBK provided us with a license in 2015, and we've been operating fully fledged from around 2016. Until to date. We have various clients that we serve. We do serve banks, but also we serve other types of clients that are appreciative of our data. This includes our fintech, MNOs, hire purchase companies, trade creditors, and SACCOs. Yeah, so as you might have seen, we just don't only serve banks, we serve also other types of institutions. One aspect about Creditinfo is that we're one of the latest bureaus to get into the market. Because of that, we had to really try to be relevant in the market. In as much as we provide the traditional bureau solutions, such as providing credit reports, doing credit listings, we also, our main focus is in credit risk solutions. We go a step further than just providing you with raw data. We actually provide solutions that ride on the data that we hold to enable financial institutions solve specific problems that they face. And that is really our key strength. And we sometimes actually say that we see ourselves as a credit risk solution provider. Our solutions fall into 4 main categories. That is credit bureau. This includes the traditional bureau business, which is providing credit checks, credit listings. Our other arms is risk management. In that sector, we provide solutions that automate credit risk evaluation. We provide scoring solutions, decision analytics, and also collections. When it comes to risk management, we provide risk solutions that cover the whole credit life cycle, from origination all the way to collections. Then also we have business information solutions. These solutions entail providing information to our clients. A case in example is a solution called benchmarking, whereby a bank can be able to see how it is performing vis-a-vis its competition. And then also we are very keen on fintech innovation, and we have solutions around that. That includes electronic KYC, digital onboarding, and digital fraud analysis. And also something just to highlight is psychometric scoring, which enables a financial institution to actually be able to evaluate somebody's credit profile, especially for those individuals with thin files. Just to delve deeper into our product, we've got credit reports. For credit reports, these are the traditional reports that you get or you use when a client is applying for a loan. This can be accessed via a portal or via API. We also offer credit risk scorecards. Creditinfo has invested a lot in building up basically a technical know-how in creating scorecards. And for that, we've been able to create scorecards for various clients, from MNOs to fintechs to hire purchase companies, etc. Then also we have value-added products. I'll mention some of them which are quite popular. These include instant decision module. This is a solution that, in a nutshell, automates the evaluation of credit. Then there's Advisor, which is a portfolio monitoring tool. And one unique aspect about Advisor is the fact that you are able to actually analyze your portfolio with a market overview. Given the fact you're a bureau, we've got market data. When we're using Advisor, we give you that market. We are able to leverage that market data to create very we're able to get very great insights on your portfolio, which you would not have gotten if you were only to use if only to use internal data. Then also we've got a monitoring solution. This solution really provides notifications of credit events that occur within your portfolio. And again, these notifications look at the whole market. So if one of your clients defaults with another financial institutions, you'll be notified. Then also we have a collection solution. In a nutshell, what this solution does, it prioritizes your collections. That means that you're able to allot the scarce collection resources you have to maximize your collections. So Creditinfo is in over 40 countries around the world. What this means is that we've got international outlook. We are also based in Kenya. We have offices in Kenya, and we run a bureau in Kenya and also in Tanzania. That means that we can leverage our international expertise to solve the local problems. And also, we also understand the issues facing the local market, given the fact that we actually have a foothold in Kenya. So what the next slides will be around the economic impact of COVID-19. So as the charts show, and probably what you already know, is the fact that the world economy has been impacted by COVID-19. And as you can see from the tables, pretty much all the countries in the world this year will face a recession. I think the only country that will not face, which will have positive growth rate, is China, at 1%. And closer home in sub-Saharan Africa, we're expecting GDP to fall by 3.2%. And Kenya will not be left out as the world faces recession for obvious reasons. And because of the ravages of COVID-19, the World IMF has predicted that Kenya's growth rate will be at negative 0.3%, all the way down from a high of 5.4% in 2019. As you can see, pretty much the GDP growth rate this year will contract, basically not as much as the sub-Saharan region, but still will definitely be hit by the economic ravages of COVID-19. So just to illustrate that aspect, given the fact that we're in 40 plus countries, we've got credit data in all these countries, we've been able to create a short analysis whereby we compare the number of credit report usages for the first 25 weeks of this year vis-a-vis the credit report usage last year. And from that chart, you can see actually there's been a drastic fall in terms of report usages, which again shows that there's been a restriction in terms of basically people looking for credit or credit being issued by banks. So how has COVID-19 impacted lending? So banks have been affected in various ways. This include the fact that, given the fact that there's reduced economic activity, there's less demand for credit, and therefore new customer acquisition has dropped significantly. Also, the other aspect is that given the fact that there's not much economic activities, businesses have been impacted, people have lost jobs, banks have faced issues in terms of their collections, as some of these loans are also restructured or completely written off. And because lending has been restricted and collection also has been hampered, many financial institutions are facing liquidity issues. Also, something else is that there'll be, a result of this COVID-19, financial institutions have seen an increased dependency on technology. This has been as a result of various aspects, such as people, the lockdowns, the curfews, and also the social distancing guidelines issued by governments. People will not go to the branch just for any casual financial transactions, or prefer to do it online. So there's been an increased uptake of fintechs or technology that enables individuals to do financial transactions. Then also there have been a drastic need for new approaches or processes to manage daily routine activities. Most companies don't have their full staff on board. I believe in your institutions, probably at any one time, there's a limited number of staff within the institution to limit the spread of the COVID virus. And as a result of that, financial institutions and many organizations have had to rethink of how they actually run on a daily basis. And then also something else is that because as a result of COVID-19, the impact on the economy, many business plans and budgets are now redundant. This is the reason. This is because these business plans and budgets did not take into consideration a global pandemic. As of January, nobody knew that the whole economy will be crippled, the whole global economy will be crippled, and therefore the projections that are inbuilt in business plans and budgets really are pretty much are now redundant, and guys have to actually go to the drawing board. So with all this, happening, how can banks actually respond to the ravages of COVID-19? As Creditinfo, what we feel banks should do is they should monitor their risks much more carefully and respond quickly to any change in the risk profile of their portfolios. They should rethink their collection strategies. They should better manage their liquidity and also digitize their services and operations. And all that can be done by leveraging on technology, their people resource, and their other resources. So how has COVID-19 impacted Kenya? Before we begin on that, I'd like to show you this slide, which shows the utilization of credit bureaus in this market. In this market, we've got 164 subscribers. By subscribers, I mean entities that actually use credit bureaus. Out of the 164 subscribers, we have 69 of those subscribers sharing data with us, which equates to around 24.5 million unique contracts. And by contracts, I mean pretty much a loan contract. And out of that, we are the 11.5 million unique subjects, of which 235,000 are companies. So this provides you an overview of the fact that credit bureaus play a significant role in the credit markets in this country. So with the advent of COVID-19, there have been a lot of regulatory occurrences happening in this country. I'd just like to highlight a few of those. One includes the fact that for loan amounts less than 1,000, financial institutions cannot list those loan accounts, and also previously negatively listed amounts of less than 1,000 have had to be delisted as per as per the new CBK regulations. Then also banks are now required to report once every 3 months on their capital adequacy status. Another regulatory occurrence is the fact that for first-time applicants of CRB clearance certificates is going to be free of charge. And then also SACCOs have been mandated by SASRA, which is the regulatory authority, to submit borrowers' information to CRBs, which is a positive occurrence in the sense that it will enrich the data that CRBs have. Also, another occurrence is which has been quite significant, is the fact that non-regulated digital lenders and credit-only lenders at this time cannot actually submit credit data to CRBs, although they can use their data, CRB data. And then also another significant occurrence has been the fact that regulated financial institutions cannot list or cannot negatively list any loan contracts that get defaulted. So this all these events have occurred within a short spans of period. I think between 2 to 3 months, and definitely these events have affected financial institutions in one way or another. Just to show you how credit bureaus have been affected by these regulations and also by COVID-19 and the economic ravages of COVID-19. We did an analysis whereby we compared the number of credit reports usage in the first 26 weeks of this year vis-a-vis last year. And as you can see from this graph, the number of reports inquired has been drastically reducing, which shows you that financial institutions have been affected, and also CRB business has been affected. So as I've clearly showcased, COVID-19 has had an impact on the economy, on the financial industry, and Creditinfo has come up with certain solutions that enable financial institutions to better manage and mitigate the effects of COVID-19 on them. So I'll start with this solution called collections through advisor. Collection, as I mentioned earlier, is a great tool to enable financial institutions to prioritize collection. And given the fact that people have lost their incomes, default rates have gone up, collection for any financial institution today is extremely, extremely important. And therefore, this solution comes in much in handy. Some of the unique characteristics of this solution is that it's available online and it operates on a batch processing mechanism. You don't need to integrate to your core banking systems. That means that you don't need to call IT to begin to use this solution. How it works is that it's a portal. You upload an Excel file with the subject identification information. It processes that information and spits out a CSV file with the data. So it's a very simple tool to use, but very powerful. And again, this tool leverages on all the data that we actually hold. Advisor can be used for for many use cases. I'll just mention a few here. It can be used for cross-selling and upselling. It can be used to allot limits. It can be used to validate models by doing retro analysis. It can be used to ascertain data quality of a portfolio. It can also be used for IFRS 9 compliance and reporting purposes. But for this particular presentation, I'll just focus on the collections. We did an analysis, and we found out that the terminal delinquent accounts form around 20% of our typical collection portfolio. These are the terminal delinquent accounts are those accounts banks have given up or financial institutions have given up in actually making an effort to collect from them. From what we found out is that 25% out of those terminally delinquent accounts actually those individuals are active and they're actually paying to other lenders. And what advisor does, or the collection component or the advisor does, it enables you to identify those individuals as such that now you can actually begin to collect from them. From our statistics, if you assume like 1 billion Kenyan shilling is the value of the collection portfolio, from using advisor, the collection solution, you can actually get around like 80 million Kenyan shillings in terms of collections, which is quite significant, especially during this time. So collection is, as you can see, is a solution that can have quick and immediate effect on your bottom line by improving collections. So how does collection work? The collection solution, how it does it, it takes your bad book and grades your bad book according to your propensity of basically collection. What that means is the fact that you will not be seeing your bad book as being one generic a book. You'll be able to actually segment it, and therefore you'll be able to allot your collection resources accordingly. For example, as you might know, 50% of newly delinquent contracts cure themselves. Those are contracts that you'll be able to, the collection advisor will be able to identify. That means that you don't need to put too much effort into those contracts. However, with the limited collection resources, you can put in more effort in those problematic, or in those accounts that you're able to collect. And then for those collections for those accounts that you're unable to collect, or it may be very difficult to collect, you might give it out to a debt collector. So in that regard, you're able to prioritize your collection and of course increase your recovery rates. Yeah, so the collection solution is driven by predictive analytics, and in a nutshell, it provides the following benefits to institution. It's able to prioritize your collection, therefore maximizing your collection revenue. And then also something else about this solution is the fact that it's able to provide you with the newest contact details, which enables you to track down your defaulters. And then also something else about this solution is the fact that you can contact customers before other creditors. So if somebody gets a new loan from another lender, you're immediately notified, and you can actually call this client immediately and tell them that, hey, you got a new loan, why don't you pay back your existing loan. So it provides you with insights and information that will enable you to contact your customers and therefore maximize on your collections. Another solution is that we have provided is a customer relief strategy, which is a solution based on advisor. At this period in time, many financial institutions have gotten requests from their customers, request them for either payment holiday or to restructure their facility. And sometimes when banks are actually considering those requests, they don't have the full information. They only have information that this customer has with them. With this solution from Creditinfo, the banks can have much more information to make a much more informed decision on whether to provide a payment holiday or restructure a facility for the client. And with this solution, it's based on analytics that enables you to provide valuable insights, and also it enables you to optimize your customer experience as you'll be able to make a much more informed decision based on facts. So this solution uses many data points to enable a bank know whether to provide a payment holiday or credit structure. Some of these data points include historical delinquencies, changes in the debt ratio, wallet share to other lenders, number of inquiries by other lenders, the sector-specific exposures, changes to income or revenue. So it's quite a complex model that is able to crunch all these data points of a particular client, and from there you are able to actually make an informed decision. The slide that you're seeing right now shows a very simple overview of what goes behind the scenes. Pretty much in a nutshell, for any request for a restructure or a payment holiday, a client needs to meet certain pre-configured criteria for them to benefit from a payment holiday. And if they don't meet any of those criteria, they're actually rejected. And the rejection is also, and all this decision is made from a point of knowledge. The relief strategy solutions comes in two options. The first option is that does not involve want to include custom fields, and which means that it's pretty much a plug and play solution. Then the other option involves custom fields, which means that there's some form of customization. But of course, with more customization, the better, the more accurate not more accurate, but the a much more informed basis will be used for analyzing the restructuring or the loan holiday. And one aspect about this solution is that you don't need IT to come to integrate this system with your systems. It's pretty much a portal. You upload an Excel file with the contact details, and then you get back a CSV file with all pretty much indicating for each of those individuals where they actually satisfy the criteria for you to provide them a payment holiday or restructure their loan. Also, this solution also takes into consideration how the various sectors are performing. So, for example, like if somebody is in the health is in the sorry about that. If somebody is in a high exposure sector, such as the gaming, consumer durables, or they're in a low exposure sector such as defense, packaging, pharmaceuticals, this data is able to feed into the model, and therefore we are able to treat clients in these various sectors accordingly. Our next solution is monitoring, which is a very interesting solution, which enables you to which provides you with notifications on credit events or changes that occur in your credit portfolio. As you see it right now, most banks only know data about their clients, which they hold, and which is usually more transactional data that the client has had with the bank. But with Creditinfo, with a market overview, this changes everything. That means that if somebody gets a loan elsewhere, you are able to be notified you're able to know the credit behavior of this individual on a daily basis elsewhere. And that's the power of the monitoring solution. And one of the benefits of this solution is the fact that it's able to give you advance warning. That means that before a risk manifests itself, you're able to actually know, to get advance warning that this risk is about to happen. Also, something else is the fact that by virtue of you knowing that this risk is going to happen, you can take actions immediately, and therefore reduce the potential credit losses. Those are very powerful. Those are basically powerful tools or insights which banks can benefit from using a monitoring solution. And then again, just like all of our solution, it's a very simple solution. At the end of we create the rules. We create the rules. We feed it into a system. Our system every day runs the whole credit data on a daily basis on the rules, and we get an email notification of those credit events. So it's a very simple solution. No integrations required. No need of calling IT for anything. So for this solution, the credit events are categorized into three main categories. There's the red triggers. Those are credit events that occur within your portfolio, which have an adverse effect on the credit risk of your portfolio. For example, if somebody defaults with another lender, you're immediately notified. Then there are the orange triggers. These fall in between. The credit event could be both good or bad. For example, if a customer is looking for loans elsewhere, if he's a grade A customer, most likely it means that probably not fulfilling his credit needs. But if he's a bad customer with a bad grade, it means probably that he's getting rejected everywhere, and therefore you might have to really put more efforts in collection. So the orange triggers are good to know with additional insights. Then there's the green triggers. These are credit events that have got no adverse consequence on the riskiness of your portfolio. For example, a client changing the name. It's good to know, but has got no adverse impact. So, as I said earlier, this is a very simple solution. At the end of the day, you get an email notifying the credit events that have occurred for the subject that constitutes your portfolio. Then vet come in as a zip file, and and that's the format of the email once you open the zip file. So pretty much identification information, including the ID, the subject name, and then also notification type. It tells you what has happened, for that subject for that particular day. And this is information that you can provide various departments with, and they can take the necessary action. For example, like if somebody defaults on a loan from another institution, you are immediately notified, and with that information, your collection team might predict that this person might default on your loan, and therefore you might send this person immediately to collect to debt collectors or to your collection department. So it provides you with that proactive management of your risk. Something that we've been hearing a lot from our clients is whether credit risk models actually work during this time and period. Our advice is stay calm. What we mean by that is the fact that they do work, and there's no need for you to adjust. I think, sorry for that distraction. I think somebody was some noisy place. So just to repeat my point, during this period, we've been asked this question severally, whether our risk models or credit models still work, and whether we need to readjust these models. The question is that they still do work, and there's no need to, and currently it's not a good time to adjust these models because of lack of data to adjust these models. So given these facts, there are two ways which banks need to or financial institutions need to do for them to continue using these models. First and foremost, risk has across the board has increased. So one way to the adjustments required for you to use credit scorecards is to adjust cutoffs. This takes into consideration the fact that risk has increased across the board. So as a financial institutions, if you used to consider individuals with a score of 600 and above for credit, with this COVID period, with the advent of the COVID pandemic, you might increase the cutoff from 600 to, let's say, 700. In that way, you are able you're able to actually take into consideration the increase of risk across the board. Then also something to point out is the fact that credit risk models still are able to discriminate a risk. That means that if a person at A grade has a better risk profile than a person with a D grade, so that still holds. What changes is just their ability, is that the quantification of that risk, and that is by adjusting your cutoff, you're able to actually take care of that. And then the other adjustments that needs to come with the use of credit models is limit management, which pretty much means that with the advent of this COVID pandemic, institutions you should just lower the limit assigned, the loan limit assigned to a client to mitigate the increased market risk. That means if somebody could get a loan of $1 million pre-COVID, during these COVID times, the limit might be reduced to, let's say, 800,000 to take into consideration the broad-based, the risk, the increased risk across the industry. So, in a nutshell, so basically in a nutshell, what you're saying is that credit models do work. We should stick to them. The only adjustments that we need to make is the cutoffs and the limit assignments. So in conclusion, from this presentation, we've seen that economies have been ravaged, and many sectors in this country have also been affected, including the financial sector. Going forwards, we'll definitely see a decline in the number of loans issued by financial institutions. We'll also definitely see a huge rise in the non-performing loans across financial institutions, and there'll be liquidity stresses. However, what we are saying is that banks should not just sit there and do nothing. They should proactively take measures to protect and mitigate the effects of the financial crisis as a result of COVID-19. And how can banks do that? In a nutshell, what they need to do is, first and foremost, they need to be on top of the information around their portfolio. That means that they really need to get to understand any changes to the credit profile of their portfolio and take immediate action. And then also they should they should still continue using their credit scoring models, but just make adjustments that I've just pointed out earlier. Yeah, so with that, I come to the conclusion of my presentation. And there's something that I would like to mention, which is a great thing. The monitoring solution that I've just presented, we have an offer for it, whereby if you subscribe to it, it will be free of charge until September 30th. We provide you 7 core rules that we feel are very important for you to monitor, to monitor your portfolio with. These seven rules will enable you to actually get insights around what is happening on your portfolio on a daily basis from a market perspective. And it's very easy for you to get enrolled. Within 1 day, you can be receiving those emails. And in case you need to actually subscribe to a monitoring solution, which is going to be free until September, you can get in touch with either me, Chris, or Steve, and we'll be able to set you up. And in case you've got any further questions, or you need further, or you need us to have a further discussion on any of our solutions, feel free to get in touch with us. Thanks a lot, everyone, for taking the time to present. I think I'll leave this stage for questions. Over to you, Lemuel.